Ever wondered who is winning the ultimate battle between buyers and sellers when the market suddenly freezes? Welcome to this comprehensive masterclass series. In this complete series, I am going to break down the 5 most powerful Doji candlesticks that you will see on the chart every single day: the Standard Doji, the Long-Legged Doji, the Dragonfly Doji, the Gravestone Doji, and the Four-Price Doji. Mastering these 5 candles will completely change the way you look at market reversals. We are starting with the most common and foundational one that appears everywhere. Part 1: the Standard Doji. Let's break down exactly how it works and what it means for your next trade. Look at this perfect plus cross sign. This is the Standard Doji. What makes it unique is that the open price equals the close price, creating a tiny to no real body at all, which represents absolute market indecision. The upper shadow shows the farthest point sellers forcefully pushed the price down from, while the lower shadow marks the lowest level, where buyers stepped in to push the price back up. Both sides fought hard, but look at the center. It is a state of complete equilibrium. Highs equal lows, open equals close, and there is no clear winner. When you spot a Standard Doji after a strong trend, it is your ultimate warning sign that the current move is losing steam, and a massive trend reversal is right around the corner. Now, let's move on to the next powerful pattern, Part 1: the Dragonfly Doji. This specific candlestick is a major sign of rejection and a potential bullish reversal. Look at this distinct T-shaped structure. Just like the Standard Doji, the Dragonfly Doji features a tiny to no real body because the open price equals the close price at the very top of the candle. However, what makes it incredibly powerful is its long lower shadow. This long lower shadow tells us a massive story about market psychology. During the session, the price fell sharply as sellers pushed down aggressively, taking total control at the bottom. But right at those low levels, buyers stepped in with immense strength and forcefully pushed the price all the way back up to where it opened. This represents a complete rejection of lower prices. This candle matters most when you spot it at the bottom of a downtrend or sitting right at a key support level. It signals that the heavy selling pressure is finally weakening, and buyers are preparing to take over for a potential upward reversal. In consolidation zones, it simply indicates strong market indecision and a possible breakout. But remember the key takeaway for your trading strategy. The Dragonfly Doji shows buyer strength, but you must always wait for confirmation from the next candle before aggressively opening a buy trade. Next up, let's look at the exact opposite pattern, Part 3: the Gravestone Doji. This candlestick forms a distinct inverted T-shape and acts as a powerful warning sign for a potential market drop. Look closely at this structure. Here, the open, close, and low prices are all virtually identical and sit right at the very bottom of the candle, leaving a tiny to no real body. The defining feature of this pattern is its long upper shadow. This long upper shadow reveals that during the session, buyers stepped in aggressively and pushed the price significantly higher, trying to maintain an upward momentum. However, they completely failed to hold those high levels. Sellers forcefully entered the market at the top, took absolute control, and slammed the price all the way back down to where it opened. This long upper shadow shows extreme rejection of higher prices combined with intense seller strength. When you spot a Gravestone Doji at the top of an uptrend or hitting a major resistance level, it serves as a highly reliable bearish reversal signal. It tells you that the buyers are completely exhausted, selling pressure is taking over, and the market is preparing for a massive downward move. Finally, let's look at the rarest pattern in the family, Part 4: the Four-Price Doji. This candlestick looks entirely different from the others because it forms a single, flat horizontal line. Look closely at this unique line. In a Four-Price Doji, the open, high, low, and close prices are all exactly the same value. There are absolutely no upper or lower shadows, which means there was zero price movement throughout the entire session. This flat line represents a state of total equilibrium and an absolute standstill in the market. It is the ultimate indecision signal, indicating complete neutrality where neither buyers nor sellers are participating. You will usually see this rare candle form in highly illiquid markets, or during pre-market and after-hours trading when there is almost no volume. It tells you that the market has completely paused, and you must wait for a clear injection of volume before making your next move. Now, let's look at another highly significant pattern. Part 5. The Long-Legged Doji. This candle is the ultimate symbol of a fierce market, struggle and extreme uncertainty. Look at this dramatic structure. Just like other doji candles, the open and close prices are nearly identical, resulting in a tiny to no real body, which shows strong indecision between buyers and sellers. However, what sets it apart are the very long upper and lower shadows. These extended shadows tell us that during the trading session, the price moved sharply both upward and downward with massive volatility. The buyers fought hard to drive the price to a high point, and the sellers pushed with equal force to slam it down to a low point. But despite the chaotic movements, neither side could maintain control, and the market closed right back near the opening price. This pattern matters most when it appears after a strong, extended trend at the top of an uptrend. It warns you that the upward momentum is weakening, and a bearish reversal down could be near at the bottom of a downtrend. It signals that the selling pressure is exhausted and a potential bullish reversal up is on the horizon. Even in a consolidation zone, it highlights heavy market indecision just before a breakout. But remember the key takeaway for your trading strategy. The long-legged doji proves a massive loss of trend momentum, but you must always let the next candle confirm the actual market direction before entering a trade, and that brings us to the end of our Ultimate Doji Masterclass. If you found this breakdown valuable and want to stop losing money to fake breakouts, make sure to smash that like button and subscribe to the channel right now so you never miss our upcoming professional trading guides. Also, I want to hear from you. Which doji pattern do you see most often on your daily charts? Drop your answer in the comment section below, and let's discuss. Thank you for watching, keep practicing, and I will see you in the next video.